Australians are reeling from one of the worst natural disasters to ever hit the continent, and tens of thousands of Aussies have been forced to evacuate due to flooding, the likes of which has never been seen down under. I'm John Weber for AM Best TV, and I'm speaking today to Yi Ding, Senior Financial Analyst in AM Best Singapore office. Yi, so glad you could join us today.
Thank you. Hello, John.
So, Yi, what do we know about how much of a financial impact the flooding has caused in Australia?
Well, the estimated current cost of this event is at 2.5 billion Australian dollars, according to the Insurance Council of Australia. So going forward, as more claims are submitted and settled, this number could potentially increase over time. I think a comparison can be drawn from historical major flood events, such as the 2011 Brisbane flood and the 1974 Brisbane flood, which had insured losses of approximately 2 billion and 3 billion respectively. The final insurance bill from this event will also depend on a number of factors. So, for example, it could be subject to demand surge and inflation as a result of increase in labor costs and the materials in the country, noting prices are already at inflated levels due to supply chain issues and increased demand after COVID-19 lockdowns in the country. The conflict in Ukraine has also exacerbated the upward price momentum given the higher oil price and constraints on the supply of certain commodities.
Do we know what to expect in the way of insurance claims?
Yeah, I think general insurers in Australia typically purchase cat excess of loss reinsurance with a relatively high limit, which is generally above a 1 in 200 year level. So our expectation at this stage is that losses from these floods are going to be below this threshold, which means the majority of losses is likely to be borne by the reinsurance industry. So for the direct insurers, I think their net exposure will depend on how this event is treated by reinsurance contract terms. So if the flood is treated as multiple events, this could lead to higher net cost and higher usage of aggregate reinsurance cover for direct insurers. However, as the net retention on cat programs are typically low relative to the insurer's capital base, our expectation is that this event will have limited impact on the company's solvency in Australia. I think it is worth noting that Australia has seen a period of above average weather-related losses in recent years. For example, in the last 3 years, we had the Townsville floods in 2019, the bushfires in late 2019 and early 2020, and the hailstorms in January 2020. And if you compare the total cost of those cat events in the last 3 years against those in the 3 years prior, the total cost has more than doubled. In addition to that, the industry is still facing ongoing uncertainty over exposures to business interruption claims. So as a result, another major weather event is likely to add to reinsurance pricing pressure and potentially reduce reinsurers' appetite for property insurance in Australia. So there may be concerns among reinsurers over the number of large cat events hitting the market year after year. And this is within the wider picture of a global hard market for reinsurance rates. In recent years, we have seen large global reinsurers such as Swiss Re and Munich Re taking actions to reduce capacity for property aggregate and event frequency covers. So this means for Australian insurers with significant reliance on reinsurance, reinsurance pricing may have a substantial impact on their operating results going forward. In particular, insurers with exposure in cat-prone areas will be most vulnerable to increases in the cost of reinsurance.
Yi, how is the Australian insurance market positioned for such devastation?
Yeah, I think with the increased frequency of weather events in Australia in recent years, we expect to see an increased focus by both insurers and the reinsurers on controlling and mitigating climate risk. I think the recent experience will also reinforce the need for insurers to improve their underwriting, capital management, and ERM in order to support risk selection and pricing for weather-related exposures. These actions may then lead to rate increases and tightening of terms for policyholders. And I think going into the next reinsurance negotiations, insurers are likely to find pricing and conditions tougher. And we could potentially see insurers increasing their retention levels to control costs or altering the coverage between proportional, aggregate, and cap programs. And finally, in terms of government support, we note that there is ongoing discussion on the political response to the disaster and whether a government-supported pool should be created for flood risk, given a reinsurance pool for cyclone risk has recently been established, which is backed by a $10 billion government guarantee.
Yi, thank you so much for taking the time to speak with us today.
Thank you so much.
That was Yi Ding, Senior Financial Analyst in AM Best Singapore office, and I'm John Weber for AM Best TV.